FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and well, stock market is making new highs, in the process of making new highs. What does it mean for you? What does it mean for the economy? What does it mean for the market as well? And does that mean that it's peaking? Are we finally going to see a stock market peak, or is it just going to keep going on and on? Well, we're really pleased that Crista Huff of Cabot Wealth Network, and you find it at Cabot, CABOT wealth.com, is with us to help clear things up for us. Crista, it's great to have you back. So market just keeps going up. Oh, and I would be remiss in not giving you our email address, so you can email us, kl@kerrylutz.com, with your thoughts about where the market's headed. So Crista, the real economy, it's chugging along at 2% GDP growth. That's subpar, 1.9% last quarter. And the stock market, though, seems oblivious. Is this a conflict?
I wouldn't call that GDP growth subpar. We've been having consistent GDP growth for several years without any big downside. We're not getting quarters that are 0.5% or anything like that. So I've been happy with GDP. I've been happy with inflation, although I do see several inflationary things on the horizon, which we can talk about shortly. The stock market rose tremendously in 2016 and 2017. It rose about 57% over a 2-year period, and then it came to a standstill. And since January 2018, the stock market is only up 7.2%. So that's almost 2 years, but just 7.2%. So that's actually a very low number. So if people are worried that the stock market is high, yes, it was appropriate to worry back in January 2018. And I was actually warning people, hey, we're due for a 10% correction. And then boom, the market fell 9.9%. And that's a good thing, because when the market goes up too much, too fast, it needs to pull back and correct. So it did that. It took 1.5 years or longer to digest that correction, and now it's just starting to make new highs again. So I think all systems are go, and I am absolutely buying stocks.
So it's full speed ahead, huh?
Yes, definitely. I actually bought options for myself today because I think things are going to really be popping this month.
Mm-hmm. So what about trade wars? What about everything that's going on? QE4, we're looking at QE4 now, although they're not calling it that. The meltdown in the repo market, none of that's going to have any effect upon the stock market?
Everything has an effect on the stock market. And I'm not really your expert on the meltdown in the repo market, unfortunately. But I can tell you what I'm witnessing regarding, quote unquote trade wars. So we get a lot of news headlines that are very gloom and doom. So one of the things that people need to remember or take note of is that the U.S. has had trade problems with China forever. And we have not had any president address these problems until the current president. So I know that it seems like everything was fine, and then the current president screwed everything up. But actually, the U.S. was taken advantage of with trade with China for many decades, and we finally have somebody addressing it. Now, that doesn't mean we can solve any of these problems, because no matter what we do, if China doesn't agree to it, all of those problems will, to a large extent, continue to exist. But so the important point is, A, the problems are not new, and B, the U.S. is not causing them. The U.S. is actually trying to solve them. And so I ignore the headlines, and I go to the quarterly earnings reports of the companies that are manufacturing things in Asia, companies like apparel companies and footwear companies and electronics companies. And what I'm seeing, to a very large extent, is only, let's say, maybe 1 out of 4 of these quarterly reports mentions anything downbeat about China and trade and tariffs. and that maybe they're being affected negatively. The others are actually quite upbeat. They're saying that they're not being affected, that they are moving production to other countries such as, let's say, Malaysia or Mexico, and that they are finding other ways to mitigate the costs of tariffs, and that it's not affecting the bottom line. So when you read these earnings reports, it's actually, overall, it's relatively upbeat. And that's the biggest reason why I'm not remotely concerned about trade wars, because it's not affecting the companies that I invest in.
So, but it surprises me, Amazon, which is totally hooked into the China economy, China industry, really hasn't suffered any from this. So what is the market trying to tell us here?
If corporate America were truly suffering, truly, like the bottom line, the profits, the revenues, all that, the stock market would not be making new highs. So I think we've got this big divergence between what the news headlines are telling us and the actual corporate performance. Now, regarding Amazon, coincidentally, I was looking at that stock just yesterday, and the numbers, I think, look really attractive. The share price has been stagnant for about a year and a half during that same period that I just talked about, where the broader market had been stagnant. And so I guess I might as well tell you right now that I had planned to add Amazon to my Cabot Undervalued Stocks Advisor portfolio tomorrow in my November issue. So your listeners are hearing about this right now, right before my subscribers. I don't know if that's fair, but there it is.
Okay.
There's short-term upside in the stock of about $200 per share, which is about an 11% very short-term upside as the stock recovers to its July high up around 2025. And then earnings growth is attractive enough and valuation that I think both short-term traders and longer-term investors could really benefit from buying Amazon right now.
And so even at its current valuation, so how much longer can this go on for, Crista? I mean, everybody, this is the least loved bull market in history. For the past 10 years, it's been going on. We're on our 11th year now. And can that just keep going?
All right. So let's circle back to why stocks go up and whether it's normal or not. A share of stock is a piece of a large company. When you own a share of Amazon, you own a piece of Amazon, the company. Now, granted, it's a small piece, but the value of your stock should, over time, go up if the company itself is growing and profitable, and the value of your stock should go down if the company is suffering, if it's losing money, et cetera. So because and that's why we want to buy quality stocks. If we buy Bristol Myers, if we buy Amazon, and we know that they are profitable companies whose profits are growing, we have a clear expectation that our share price should go up over the medium and long term. Now, granted, over the short term, several days, weeks, or months, literally anything could happen. So I'm never talking about the short term when I'm saying, hey, you can make money in stocks. Stock investors who buy quality companies, it's almost guaranteed that over, let's say, a 5-year period, they are going to make good profit and do much better than they would have in the bank or with bonds. Can we agree on that?
Mm-hmm. Oh, sure.
So when people are worried about stocks going up, I think their worry is somewhat misplaced. What I would worry about is if we had a recession representing companies not thriving, companies not growing their profits and revenues, companies laying people off. But nothing like that is taking place right now. So for now, if companies are growing, theoretically their share prices should also. And you don't have to be an economist to know when it is time to worry. Here's what I tell people all the time. When your friends are losing their jobs, when your coworkers are getting laid off, when you go to church and you run into your good friends and they're worried because the husband just lost their job, that is when the average investor should know, something's happening that's not good. And this is reflecting a poor business environment, and therefore it's going to reflect poorly on stocks. So if you really want to, let's say, every 3 years or so, move your money into stocks or out of stocks, the moment you start seeing that people are being laid off, you should be paying very close attention. And if it's more than one or two people in your network at that time, I would say just switch your mutual fund money and your 401k from the stock fund into the money market fund, and give the whole thing, 6 to 12 months to sort itself out, but then be ready to buy low. You don't want to wait for the market to recover. You want to get out before it falls, and then you want to get back in while it's cheap. And if you don't know if it's cheap yet, you just find me on Google because I guarantee you I'll be writing about it and talking about it weekly, until I die.
So what about, there are certain sectors of the economy that aren't doing well, like retail sales? The retail apocalypse seems to be continuing and, in fact, even gathering steam. And Do you think that's an area of concern?
The broad retail landscape is not thriving. A lot of that has to do with people buying things online. So if you find retailers who have a good online presence and they have a very specific marketing plan to develop that online presence, that could be a good company to invest in. So what I look at, first of all, profit growth is my first line of defense. When I'm researching a stock, I look to see, are their profits growing this year and projected to grow next year? I don't care how their profits did in the past, because the future is everything, in the business world and in the stock market. So while there are many retailers out there whose profits are just treading water and not really growing, there are several that are actually growing profits extremely well. And those are the ones that I recommend to people, such as Designer Brands, which is the DSW wholesale retail shoe chain, Abercrombie and Fitch, Guess, and then in other areas of retail, I will tell you that Lowe's is growing profits tremendously in comparison to Home Depot. So I know people like to shop at Home Depot, but if you're a stock investor, Lowe's is actually the much more attractive investment. Restoration Hardware, which is now called RH, they have an incredible growth model right now. They're growing like crazy. So there are pockets of retail that are good to invest in. And the reason you don't want to ignore them completely is, in general, you want to manage your stock portfolio similar to an institutional investor. So pretend that you're managing a large pension fund or a Fidelity mutual fund, something real big. Those portfolio managers need to be invested in every major sector and every major industry. So they're not going to ignore retail stocks. What they're going to do in a climate like this is they're going to pick and choose the best of the retail stocks. And that is exactly what I do. I don't sugarcoat this. I don't tell people, hey, retail's booming. Instead, I tell them, look, retail is serious right now, and you have to be in the right stocks to make money, and you have to avoid stocks like Macy's that are just having profits fall year after year. So I know that people like to invest in things, foods that they eat, in places where they shop like Home Depot. But I have found that if you take a numerical approach and just very basic numbers, profits and revenue, if they're growing, then you're removing a lot of risk from your stock investment.
Yeah. So growth is the cure to risk then, huh?
It helps. There are many ways to mitigate risk, but growing profits and revenue are a good place to start.
Well, interesting. So you're kind of a contrarian view. I mean, I guess if you work for a mainstream financial company, bank, brokerage house, whatever, it's always be buying, regardless what the fundamentals are. But in this case, you're urging cautious optimism, or are you unbridledly optimistic?
FSN Radio. It's all about what's next.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has an excellent shareholder base, with Ross Beatty owning 20%, insiders 5%, 5%, and Resource Capital Funds 8%. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
The Financial Survival Network. It's all about what's next.
On the broad market right now, I'm doing Unbridled Optimism, and I started writing about that about 3 weeks ago. I started telling people the S&P is about to start reaching new highs. But at other times, I have absolutely told people we are about to get a 10% market correction. Hold off on your purchases until the dust settles, and then within weeks of that, of that market correction, while the market's still low, simply because I can read price charts and I can see what the trends are doing. I jump in and say, okay, it's time to buy low. And when I buy low, I generally start with the companies that have real big dividend yields, because if a stock is a high quality company and the dividend yield is like 6%, it's very unlikely to fall any further because the 6% yield itself is so attractive that the big boys come in and start buying a lot of it to lock in that dividend. And yeah, it might be, 3 weeks or 3 months before the stock starts to recover. But if you lock in that high dividend while the price is low, then as the price recovers, you're making not only your profit, but you're making that 6% dividend yield forever until the company raises the dividend again. So, I try to, look very realistically at the market. I don't want to suggest to people that they buy things that are going to go down a whole bunch in a month. That doesn't benefit anybody. So I'm very, very happy to tell people, don't buy any more of this right now. The price chart is bearish. It's a great company, but stay away from the stock at this moment, and I'll let you know when it's time to buy again.
Mm-hmm. So you got to use a strategy, obviously, is what you're saying. But now It looks like things are going to turn around. Hey, what is this saying about the election? I don't want to get into the political aspect of it, but it seems to me that the market is saying, hey, we've had a good 3 years and we're going to get 5 more, well, at least 1 more, but probably 5 more good years.
I will say that since the market is reaching new highs, the market is not worried right now about the outcome of the election. And you and I don't have to predict who wins, right? It's more important to understand that the market is not worried right now. Mm-hmm. So again, regarding, the trade war topic is fizzling as earnings reports are showing that it's not actually harming a broad spectrum of companies. Now, granted, there will always be pockets of companies that benefit or are harmed more than the rest of them. And so I'm not saying nobody's suffering from tariffs. I'm saying from a broad point of view, the tariff situation is fading as a big worry. Same thing with the election. And again, there will be people who are greatly disappointed or pleased on the outcome of the real election, and that's somewhat separate from their stocks.
And let's not forget the old Wall Street saw, Crista, that stocks climb on a wall of worry, right?
Yeah.
So we've certainly had a wall of worry, probably a tsunami of worry, a 500-foot tall tsunami of worry, and it's breaking very far short of the shore. So I guess, right. And the other saw that I always love, and is so true, is a trend in motion continues until it stops. And this trend shows no signs of stopping, but that doesn't mean it couldn't. Mm-hmm. And I'm sure you're ready to change your position at any given moment, right? You're not married to this position, right?
Right. I'm monitoring inflation and GDP, especially net charge-offs at financial companies. That's going to be a big flag to me. When the economy starts to falter, I'm going to see it with loan and credit card net charge-offs way before anything like that is reported on the news and before people start losing their jobs, I think. And so right now, even in this earnings season a few weeks ago, the market was very surprised that some of the major banks that have credit cards, like Citigroup, for example, reported net charge-offs lower than what those companies had even expected. And net charge-offs are basically when somebody has a credit card and they're not paying on time and the bank is writing off the money because they've given up hope that the consumer's ever going to repay it. Those are the charge-offs. So you want a low number on charge-offs to indicate that the economy is doing well. So when those numbers start to rise, I'm going to see it immediately in monthly or quarterly numbers that I review on a regular basis. So again, things like recessions and poor economies don't have to come as a big shock to people. They could just learn, a couple of numbers to review once a month, and then they can either retain their confidence in their stocks, or they can be on the alert and be ready to maybe move a little bit out of stock. So for now, I'm not alarmed by literally anything that's happening, but there is one thing that's starting in January that I'm going to be paying close attention to, and that is the International Maritime Organization has mandated that the ships and tankers, there are 39,000 of them on the world's oceans, and they are going to be required to either use scrubbers or low sulfur diesel fuels in order to minimize sulfur oxide emissions into the atmosphere. And so basically they're going to be buying this low sulfur diesel fuel, which is going to be costly. And it's going to increase the prices of all of the products that are shipped around the world. And then that cost is going to trickle down to consumers as you and I buy cars and televisions and tchotchkes from Walmart. All those prices are going to go up, and that's going to lead to inflation. So,
no doubt.
So I think we're going to have a big turnaround in real inflation numbers, and no one's talking about that.
Yeah, I think the markets are kind of signaling that. Gold prices are up, precious metals. Forget about gold, though. If we look at palladium, platinum is starting to rise, rhodium, which is an element that nobody cares about, but all this stuff goes into catalytic converters. When they mandated a low sulfur diesel fuel for buses and trucks in the U.S., this led to a major increase in the price of diesel fuel. There were spot shortages. It was a real challenge for the world's refiners to actually produce this fuel. And, the amount of pollution caused by ocean-going vessels is a minuscule fraction of the total global air pollution. It's not even meaningful. It's less pollution created than the airline industry. So, this is a cure in search of a disease, but that's the way environmentalists work often. So,
I would have to somewhat agree with you on that, that this was maybe not the biggest pollution problem in the world that anybody should be addressing. However, if you are on the staff of the International Maritime Organization, this is the pollution situation that you have the ability to address, and so they've turned it into a mandate. So then the question for stock investors becomes who will benefit and who will suffer, and how should I reposition my portfolio if I want to move something around? And like you were saying, the oil refining companies are in the hot spot to produce this low sulfur diesel fuel. And fortunately, they've had so much warning that this was coming that they have been able to adjust all their operations to prepare to deliver this fuel. And across the board, whether it's Valero or PBF or Marathon Petroleum, they are projected to earn incredible profit increases next year to the tune of 50 to 100% profit increases per company. It's outrageous. And so I'm definitely recommending that people either own one of those individual stocks to capitalize on the potential capital gains, or there's an ETF from Van Eck, and the symbol is CRAK, CRAK, and that one invests in oil refining companies as a group and globally. So it isn't just U.S. oil refining companies. So if if you're nodding your head in agreement saying, yes, I understand that refiners are really going to profit from this, then the ETF that you want to own is crap.
Mm-hmm. All right. I like that. And hey, just tell us, Cabot is the best URL to reach you at. What's the website?
Sure. It's cabotwealth.com, and Cabot is CABOT. And I am Crista Huff, and people can reach me at Crista@cabotwealth.com. But you want to spell Crista right. It's CRISTA. And if you have trouble finding me, just type in something similar to my name on an internet search, and you'll find me. And I'm happy to answer brief email questions, but I can't advise you on your entire portfolio.
I understand that. Hey, if you're looking for free advice, no. But if you're looking to get a better insight into the markets, into what's really happening here, then please write Crista. Write us too, KL@CarrieLutz.com. Let us know what you think of Crista's thesis. I tend to agree with it. I felt for quite some time, Crista, that the market was going higher. I will say not so much because of fundamentals, but rather because of a lack of other investment alternatives when you're getting a very little return on bonds in the on CDs and money markets, then you're really looking at the stock market, wherever you might be, and the U.S. being the best, most stable market in the world. Probably the money's coming here, and also looking at higher risk sovereign debt. You know, the inclination is for people to move their money into the market and get some type of return, which you mentioned before. So I totally agree with you. Hey, like I said, any questions or comments, email us, KL@CarrieLutz.com. The Twitter feed is @CarrieLutz. Facebook page is Financial Survival Network. And please just like, share, subscribe, regardless what platform you're on, whether it's a YouTube or a podcast platform. Please spread the word. Let people know. It really helps us a lot when you do it. Crista, it's always great to have you on. We'll talk to you again real soon.
Okay. Thanks. Be well.
FSN Radio. It's all about what's next. Go to FinancialSurvivalNetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.